If Social Security is part of your monthly income, what's happening in Congress right now could touch your check. And most people only find out after the fact. There are 3 changes worth watching closely. One is already law and has quietly raised benefits for millions who were shortchanged for years. Another affects nearly every recipient this year, and many misunderstand it completely. But the third is the one everyone's asking about: long stammers. The long-term future of the program itself. What it really means for your benefits might surprise you. Let's separate what's real from the noise. This matters most if you currently receive Social Security, plan to claim soon, or worked in a public job like teaching, firefighting, or government. If you rely on your monthly check to cover the basics, these 3 changes deserve a few minutes of your time. Let's start with something that's already done, because this one isn't a proposal, it's law, and it's putting money in people's pockets right now. It's called the Social Security Fairness Act. It was signed into law in early 2025, and it ended 2 old rules that reduced benefits for certain public workers. Those rules were the windfall elimination provision and the government pension offset. Long names, but the idea is simple. For decades, people who worked in jobs that didn't pay into Social Security, think many teachers, police officers, firefighters, and government employees, often saw their Social Security benefits cut. That included benefits based on their own smaller work history and spousal or survivor benefits based on a husband or wife. These 2 provisions shrank those checks. The Fairness Act repealed both of them. Here's who this affects. If you or your spouse earned a public pension from work that wasn't covered by Social Security and your benefit was reduced because of it, that reduction is generally gone now. And this change was made retroactive, so many people were owed back payments, as well as a higher ongoing monthly amount. Here's a realistic picture. Imagine a retired teacher who also earned some Social Security from other jobs, but whose check was trimmed for years because of these rules. Under the new law, her monthly benefit can rise, and she may have received a lump sum for the period she was underpaid. So what should you do? If you think you were affected, check your benefit statement and your FIFA site. Your är secured to problem for aktiga from att kan distort at a rear reliever fesselt stit. HWS sites touch aitavs dot corv or ub, or contact Social Security directly. Many increases were applied automatically, but it's worth confirming yours was handled correctly. Now, the important limitation, because this is where people get confused, this change only helps people who were actually subject to those 2 provisions. If you spent your whole career in jobs that paid into Social Security, these rules never touched you. So there's no change and no back payment coming. Some people heard the headlines and expected a windfall that was never meant for them. That quote is the one that's already settled. The next change touches everyone who gets a check, and a lot of people misread what it actually does to their income. Every year, Social Security benefits can rise through something called the cost of living adjustment, or COLA. It's meant to help your benefit keep pace with rising prices. For 2026, that increase is 2.8%. That sounds like good news, and it is. But here's the question almost nobody asks. Does a bigger benefit ever come back to bite you? Sometimes, yes. And here's how. Let me explain the mechanism. Your Social Security benefits can be partly taxable depending on your total income. The government uses a figure often called combined income. Roughly your adjusted gross income plus any tax-free interest, plus half of your Social Security benefit. Once that number crosses certain thresholds, a portion of your benefits becomes taxable. For a single filer, once combined income passes $25,000, up to half your benefits may be taxable. Above $34,000, up to 85% can be. For married couples filing jointly, those lines are $32,000 and numbers $44,000. Now here's the part that catches people off guard. Those income thresholds do not rise with inflation. They've been frozen at those same levels for many years. But your benefit goes up with the COLA. So over time, more and more retirees find that a bigger slice of their benefit becomes taxable. Not because tax rates changed, but because their income drifted past lines that never moved. Here's a realistic example. A retiree gets the 2.8% raise for 2026. It helps with groceries and utilities, but that slightly higher income nudges them past the threshold, so a bit more of their benefit is now taxable. The raise is still worth having, but flattasen TDI. From a hedgehybeligstrengt 10 was het vermoedend sold by CBS, with up to limit the morestith that have been suggested. If your total income is low enough, if your banter night more factual benefit not be taxed at all. Millions of lower income retirees owe no federal tax on their Social Security. So this trap mainly hits those with a retirement account numbers or work. Here's a short warning worth remembering. Don't assume the full 2.8% lands in your pocket untouched. For some people, part of the raise is offset by higher Medicare costs pulled from the same check, or by a bit more tax. So what should you do? Look at your total income, not just your Social Security. If you're near one of those thresholds, it may be worth talking to a tax professional about the timing of retirement account withdrawal. And keep an eye out. There have been repeated proposals in Congress to reduce or eliminate taxes on benefits, but a proposal is not a law until it passes ... That question of what Congress might do next brings us to the big of all, the one everyone worries about ... This is the change generating the most fear and the most confusion, which is exactly why it's the most important to understand clearly. It's the long-term funding of Social Security itself and the pressure on Congress to act. Here, quote, "S why this matters more than the first two. The Fairness Act helped a specific group. The COLA and tax issue affects your income at the margins. But this touches the foundation of the entire program, and the headlines around it are often misleading. ... Let me give you the facts as they stand. Social Security is largely funded by payroll taxes from today's workers, plus reserves held in trust funds. According to the most recent trustees report, if the retirement and disability trust funds are considered together, their reserves are projected to be depleted around 2034 unless Congress acts. Now, read the next part carefully, because this is where panic takes over and accuracy gets lost. Depletion of the trust fund does not mean Social Security disappears. It does not mean checks stop. Even in that scenario, ongoing payroll taxes would still fund the large majority of benefits. The projections suggest roughly 80-something% could still be paid. So the realistic risk being discussed is a potential reduction if nothing is done, not a total shutdown. Here's a plain example of the misunderstanding. Some understander. Someone hears, the fund runs out in 2034 and assumes their benefit vanishes that year. That's not what the projection says. What it says is that without changes, benefits could be reduced to what incoming taxes can cover. And this is where Congress comes in. There are competing proposals on the table. Some aim to increase revenue, for example, by applying payroll taxes to higher earnings. Others focus on adjusting benefits or other program rules. Some proposals would even expand benefits. But, and this is critical, these are proposals, not enacted law. None of them changes your check unless it actually passes both chambers of Congress and is signed into law. So who should be watching most closely? Younger retirees and people still years from claiming, because any long-term fix would most likely phase in over time. If you're already receiving benefits, sudden changes to your current check from a solvency fix are far less likely in the near term. The biggest misunderstanding of all, that you need to claim early in a panic to lock in your benefit before it's gone. For most people, that fear-driven decision can backfire, permanently lowering the monthly amount you receive for life. A projection years away is not a reason to make a rushed, irreversible choice today. So what's the correct next step? Stay vent with not very system. A stains de forts, den når real changes distro not haben med Troy and hells are highly you can stay outsled. And then two mitsender text the cornida, against on it come, as slayer and distion is thou done. And one defined is on wall, what activity becomes law, becomes might give your headline. That funner thing that here's unfair will be encompassed. Here's one distinction that trips up a lot of people, and it's worth keeping separate in your mind. Social Security retirement benefits are not the same as supplemental security income, or SSI. Retirement benefits are based on your work history and the taxes you paid over a career. SSI is a separate program for people with very limited income and resources who are 65 or older, blind, or disabled. When Congress debates Social Security, these programs sometimes get lumped together in the headlines, but they follow different rules and different funding. Why does this matter? Because a change to one may not affect the other. If you receive SSI or both, a news story about the retirement trust fund may not describe your situation at all. When you read about a proposed change, check which program it actually applies to before you assume it touches your check. Confusing the two leads people to worry about changes that were never aimed at them. Let's turn all of this into a clear plan in the right order. First, create or log into your account at the official site, ssa.gov. This comes first because everything else depends on knowing your own numbers, your benefit amount, your earnings record, and your recent payments. Guessing helps no one. Next, if you or your spouse worked in public service with a pension, verify whether the Fairness Act changes were applied to your benefit and whether any back payment was owed. Confirm this directly with Social Security rather than assuming it happened correctly. Then, review your total income for the year, not just your Social Security. Compare it to the taxation thresholds we discussed. If you're close to a line, that's your signal to ask a tax professional about the timing of any retirement withdrawals before year's end. Before you make any decision about claiming or changing benefits out of fear over the trust fund, pause. Base that choice on your health, your income needs, and your plans, not on a headline about a date years away. Finally, when you hear about a new social security change, confirm whether it's an enacted law or just a proposal, using official sources. This order matters because acting on a proposal as if it were law is one of the most common mistakes people make. Each step builds on the last. Know your numbers. Confirm what's already changed. Protect against the tax trap. Avoid panic decisions. And verify everything through official channels before you act. Here's the most dangerous misunderstanding tied to this topic, and scammers exploit it ruthlessly. The single biggest error is treating a proposal like it's already law. Congress debates many bills. Most never pass. When you hear that benefits will be cut, taxes eliminated, or checks increased, ask one question. Has this actually been signed into law, or is it just being discussed? The answer changes everything. Scammers feed on the fear around these headlines. They may call, text, or email claiming your benefits are suspended, or that you must verify your information or pay a fee to keep your check during the changes. Social Security does not operate that way. It will not call out of the blue demanding gift cards, wire transfers, or immediate payment, and it will not threaten to cut off your benefits over the phone. If you're unsure, hang up. Then go straight to ssa.gov or call the official number on your own statement. Verifying through official channels, never a number a caller gives you, is how you separate real changes from the fear criminals are counting on. So let's bring it home. 3 changes worth watching. The Fairness Act that already raised benefits for many public workers, this year's 2.8% COLA, and the frozen tax thresholds that can quietly claw some of it back, and the long-term trust fund debate driving proposals in Congress. The people most affected are current recipients, those near claiming age, and anyone who worked in public service. The most important distinction to hold on to is this: enacted law changes your check. A proposal does not. If you do just one thing, log into ssa.gov and confirm your own benefit details before you react to any headline. That single habit keeps you informed and in control instead of at the mercy of rumors or scammers. The future of Social Security is being debated, but your best protection is accurate information. If this helped, consider subscribing so you stay ahead of what's real.